Hi, everybody. This is Dave Mantell with Stabler Wealth Management. Thank you for tuning in for our 2024 Economic Outlook. In this video today, we'll do a quick look back at 2023 and how the year finished, and then look forward to what's ahead in 2024. And one of our primary missions at Stabler Wealth Management is to make sure we're sharing information and knowledge with clients to help you make the best, most informed decisions that you can. All right, well, let's jump in. So following a rough and tough 2022 in the stock markets and bond markets for that matter, 2023 had a very strong finish. And looking back, it resulted in a very solid year overall. In the fourth quarter of 2023, stocks surged in both November and December, erasing a really tough October and finishing the fourth quarter quite a bit higher. And the last 2 months of the quarter resulted in the Dow Jones breaking a record and the S&P 500 advancing for 9 straight weeks for a very strong finish. Now, typically, the fourth quarter is the best quarter of the year for the stock market. And so now we can add 2023 as another year where that held true. Now, thanks to the strong finish in the fourth quarter, the S&P 500 finished a year with a massive gain of over 24%. And the Dow Jones Industrial Average also ended the year positively, up more than 13%. At a certain point back in the October area, as you can see on this chart, the Dow was nearly flat for the year. And so before that strong finish, it was a really up and down year throughout. And as you can see in the chart as well, it was not smooth sailings by any means for 2023. Between banking failures, geopolitical tensions, uncertainty on inflation, we saw quite a few big ups and downs throughout the year. And fortunately, after that strong fourth quarter finish, it all turned out to be a good year overall. The primary jump in the market at the end of the year was attributable to the Fed indicating that they're ready to pivot their aggressive monetary policy, and they may begin to start cutting interest rates in 2024. Of course, the stock market and the bond market, for that matter, latched onto this, fueling that strong finish towards the end of the year. More recently, we've seen this momentum continue into 2024, with the S&P 500 hitting an all new market high back in January, and more recently this month in February, the S&P 500 closing over 5,000 for the first time in history, a very big mile marker. Now, following a tough and bumpy last several years, it's sure been good to see 2023 end in a positive fashion, and that continue into 2024. While January, which posted an up 1.6% return in the S&P 500, which is a very solid number. And while that doesn't jump off the page, it does have some strong significance. Historically speaking, the stock market's return in January tends to be a very strong indicator for how the rest of the year will follow. And therefore, from a historical standpoint, that up 1.6% for the month could be a very good thing. Since 1950, as you can see in this chart, the S&P 500 has posted an average return of 16.8% during those years where January was positive. Also impressive is in those years where January was positive, 89% of the time, the market finished the year positive as well. In contrast, if you look at the light blue line on the bottom half of the chart, in years where January was down, it resulted in an average market return for the full year of down 1.7%. A huge contrast to the plus 16.8% average for the S&P when January's up. And on top of that, in those down Januaries, only half the time the stock market ended the year positively, going back to 1950. And so while up 1.6%, again, doesn't jump off a page necessarily, it's definitely a great way to start the year for 2024. So when we look at all the different variables going on in the economy, if we could point our finger to one item to watch, that would be inflation. And much of the strong 2023 has been the result of that aggressive monetary campaign by the Fed, seeing inflation continue to tick lower and lower throughout the year. More recently, December posted an up 3.4% inflation number. And while this is much higher than the 2% target of the Fed, it is light years lower than the 9.1% that was posted back in June of 2022. And therefore, we've seen really strong progress in terms of inflation numbers. Something to note, while we're seeing inflation continue to trend down, and a lot of forecasters think we're going to be in the 2% range in no time, this is something to watch. There's a large possibility due to the strong labor market and also some of the policies out there, including the amount of government debt and current deficits, where inflation can get pretty sticky in this range. So we'll want to keep an eye on if inflation continues to trend down from that 3.4% level into the twos, or if it stays sticky and resistant at that 3 to 4% range. Nonetheless, very good progress on the inflation front. So when you hear inflation, the next words that typically come out are interest rates, right? Because they go a bit hand in hand in terms of Fed policy. And so while the Fed did not raise interest rates at all in the fourth quarter, they stayed in that target range with Fed fund rate of 5.25% to 5.5%. As I noted during that December Fed meeting, it was indicated we could actually see several rate cuts in 2024 after that dramatic rate increase we've seen in the prior year plus. And for example, if you look back, the Fed raised interest rates a whopping 11 times since March of 2022. And so 3 times in a row to end 2023, and possibility of future rate cuts coming up can be a big impact in terms of what the market does going forward. So following that fourth quarter, as we noted, where we didn't see any Fed interest rate hikes, the first meeting in January of 2024 had the same outcome, with the Fed announcing that they were going to keep rates unchanged, resulting in 4 consecutive rate holds, which again, the investors have well received. And also again, in that January meeting, Fed Chairman Powell did indicate that while rates have likely reached their high, they do not expect to cut rates in March. But they do stand that we'll likely see a rate cut at some point this year. And so there's 7 more Fed meetings scheduled through 2024. And so this is something we're going to watch very carefully in the year ahead as we look at the outlook for the economy and the markets. I do want to note that while initially with the Fed announcing they expect to pivot this year and start cutting rates, the market's priced in about 7 rate cuts initially. And we do think that feels a bit ambitious. More recently, we've seen indications of 4 rate cuts for 2024, which may be more like it, that 3 to 4 rate cut range. And so again, it's something that we really need to watch. And on top of that, with the job market continuing to be really strong and resilient with low unemployment rates, there's always a possibility we may see rates continue where they are at this current elevated level as higher for longer. So something that we're really tuning into. With rates maintaining at higher levels, the bond market continues to follow suit. And while we've seen bond yields fall off their overall high that occurred back in October of 2023, they still stand at very attractive levels, with long-term government bonds yielding in many cases over 4% per year. This is something that we're also going to keep a close eye on. And with bonds at this more attractive pricing, it really results in a big component of your overall investment portfolio. In addition to receiving higher income yield on your bond investments, which has been a silver lining with rates coming up after nearly 15 years of close to zero rate policy, bonds can also complement your stock portfolio, where if we did see a recession at some point, for example, and the economy slowed and the stock market took a step back, many times you'll see the Fed start cutting rates more aggressively. Interest rates will come down, And we all know the old adage, when rates go up, bonds go down. When rates go down, bonds go up. And so that is a positive that in addition to the income yield that bonds are providing, it can provide some ballast and complement to your stock portfolio, where certain environments where we may see the stock market struggle might result in a nice extra bump in the bond markets if we see that traditional relationship where rates go down in that type of environment. I also want to note that interest rates and bond yields is something that we do feel like we could be very proactive of and really cater our clients' portfolios to take advantage of the current environment. And what I mean by this is right now, with the expectation that the Fed's going to start cutting rates, we've seen 2-year bonds, for example, drop pretty significantly. So at one point last year, those 2-year bonds were yielding over 5%. At one point early this year, those yields dropped to 4%. And since that, they've gone up to about 4.3, 4.4. On the other end, short-term government bonds, ultra short, so under 1 year, are still yielding about 5.3%. And so we see that as really good bang for your buck, where yes, for 1-year bonds rather than 2-year bonds, earning an extra 1% interest per year is very attractive in our view. And so things like this in terms of what term bonds do we hold? How do we pair those 1-year bonds with maybe longer term bonds that will complement the stock? These are really great ways where we could be proactive to build that to, add and complement your other portfolio holdings. And so we see a lot of value still in the bond market and a lot of opportunity for us to take advantage of. In combination with the Fed fund rate still being higher, we continue to see savings vehicles, treasury bills, money markets, ultra short-term bonds earning that over 5% yield per year, which is a great level. And so again, we really recommend continuing to grab these high yields while you can and maximize it. Still take a look at your savings account and money market and CD accounts, because across the board, many banks have not adjusted still for the higher interest rates. Much of this being, banks have struggled quite a bit in this current environment. And therefore, you want to make sure on excess savings that you don't want to be taking risk on. You're earning that 5% plus range that's still available out there. So after that roller coaster of a 22 going into 2023, recession fears that were at a fever pitch back at the end of 2022 have really significantly diminished. For example, recent payrolls in the US grew by 353,000 jobs. This is the biggest monthly gain since the last January of 2023. And on top of that, the unemployment rate remains very low at under 4%, 3.7% to be specific. And again, a very resilient economy. On top of that, we continue to see company profits perform very well too. So there's a lot of positives in terms of this economy has been resilient and really avoided and stayed out of that recession zone. And so a couple of things to note. I think for one, again, jobs numbers, strength numbers, while it's fantastic that they're holding on very well, as long as we see inflation be a little stubborn in that 3% range, the Fed may be a bit slower to pivot and cut rates. So as we noted, that's something we're really watching. And all in all, though, these indicators do show the signs that a soft landing or a very shallow recession is very possible. And more than anything, it's good that the Fed has been able to accomplish this while elevating rates and keeping them at a higher level, giving them many different tools they can use beyond, printing money, right? For example, they have rate cuts that they have in their back pocket if they do need to supplement the economy. But so far, so good. We've seen a very resilient economy so far, which has been, a positive surprise compared to what many forecasters have predicted. Okay, so while the market's been strong, the economy's been holding on well. We've seen inflation come down, which are all big positives. There's still a lot of worries out there, as there are in every point of history. And so currently, one of the biggest concerns in our view is the global economy continues to be seeing a lot of uncertainty in terms of geopolitical unrest that's out there. And this is both the heightened conflict in the Middle East, the ongoing Russia and Ukraine war that continues, as well as tensions of China that continue to climb. And so these uncertainties are always risks that can have a big impact on the economy and the markets, and something we really continue to be focused on in the years ahead. We also get a lot of questions in terms of, we have an election year coming up. What does that mean? Is that going to be more volatility, more uncertainty? And I think the easy answer is yes, in terms of ups and downs and volatility and, concerning news headlines. On top of the US elections, this is a historic election year where over 4.4 billion people across the globe could be voting this year. And so as you can see, there's a massive amount of elections with more than half the world's population potentially voting. And so there's a lot of ramifications for this. In the US, we have big elections coming up this year, of course, as well. And with a very divided political backdrop currently, you can see a lot of risks with this. It's easy to see either party contesting the outcome if they lose. There could be big ramifications to tax policy depending on how the elections go. As noted, very tenuous geopolitical situation. And so elections can also, move that one way or another. And so there's definitely a lot of risks out there. And generally, the market does not like uncertainty, of course. With that being said, over the long term, the stock market has endured election outcomes no matter which direction they've gone. And so as you can see on this chart, going back to the 1930s, US stocks have nearly always been higher at the end of a president's term in office than they were at the beginning, regardless of policy affiliation. And so it's pretty amazing looking at this chart, seeing all the switching between different, political parties in office. And despite that, the economy and the stock market have really weathered over longer periods. Also, something to remember, while we could see volatility this year, ups and downs in the market, remember the incumbent party wants to show a strong economy going into the elections. And so they're going to do whatever they can to make sure that the economy stays strong, most likely, and the market follows suit. And so while there's, of course, worries and concerns and uncertainty with the elections, a lot of times, no matter what the outcome is, that can result in more noise in the short term versus longer term impacts on your portfolio. And again, demonstrated in this chart here, if you go back to 1933, essentially, $1,000 in the stock market, going through Democratic and Republican, presidencies and back and forth, would be about nearly $22 million today. Again, $1,000 in 1933 in the stock market, growing to 22 million, hypothetically, just under that. And so again, the stock market is an incredibly powerful wealth builder. It can be very volatile in the short term, but whether it's geopolitical tensions or elections or inflation concerns, it does tend to get the job done over time and is a tremendous long-term investment. And so when we sum that up, nobody knows in the short term what the stock market's going to do. For example, in 2022, forecasters on average picked the S&P 500 to hit 5,000 at the end of the year, if you went back to the start of 2022. We all know how 2022 went. It wasn't a good year. And at the end, the S&P 500 ended at 3,839, a far cry from that 5,000 prediction. Likewise, at the start of 2023, the median forecast was the S&P 500 would end at 4,000 for the year in 2023. It closed markedly higher at 4,770. And so again, in the short term, nobody has a perfect crystal ball on this stuff. And so you want to stay in the market and stick to the game plan. And fortunately, having a long-term eye on investing, there's a lot of tools we're able to do for you to make sure we're maximizing the outcomes and personalizing your investments to your picture, between timely rebalancing, tax strategies such as investment location, where to hold what investments, personalizing your investment portfolio to your needs, your income strategy. All these things can make a huge difference in having success, even through stretches of volatility and uncertainty. And so while we enter 2024 and are very hopeful and optimistic it could be a good stock market year, again, in the short term, a lot can happen. And the main thing is having a strong plan that can weather no matter what's thrown at you. And so now is a great time to review your investments, confirm they still fit your needs and your goals. And regardless of what 2024 brings, we want to make sure we're controlling all the controllables and doing everything that we can to give you the best outcomes. So key takeaways looking back at the presentation, fantastic that inflation's been slowing. I think everyone's elated with the progress that's been made. However, it's still quite a bit above the Fed target, so something to watch. Same thing goes for globally. Possible interest rate cuts in 2024. Good chance we're not going to see the 7 rate cuts that were expected at one point. Nonetheless, any rate cuts can really move the market to the upward. Again, the economy's been very resilient, and a soft landing is looking more and more possible, which again is a real nice positive surprise there. And, volatility does not mean down stock market, right? Volatility is more up and down. And what we care about more is how your investments will fit your time horizon and your needs. And so we could very well see a lot of swings this year, though it could be a very good year, right? Time will tell. And there's a lot of factors, geopolitical, election year, that can result in swings. So the main thing is having a good plan, as we do for you as our client, having a game plan to weather that, control the controllables, and stay the course. And we have the utmost confidence that those well-devised plans will get the job done, and focusing on the long term, right? And so again, while there's a lot of concerns out there, a lot of positives as well. And so, again, I think given everything that's gone over the past couple of years, there's a lot of positives that we can point at, which is a good thing. So thank you for tuning in to our economic update. We're going to keep the communications coming on top of our regular reviews. And if you ever have a question or something you want to discuss, please contact us at any time. We take pride in being responsive and here for your needs. So do not hesitate to pick up the phone or send us an email. And overall, we just really appreciate you and all of your support. Also want to mention, join our Client Ambassador Club in 2024. These are very uncertain times, and as a benefit to our clients, we're always here to talk to people that you care about, whether it's family members, friends, or colleagues, to give them a second opinion on things. And as a thank you, we do a nice thank you event every year for those that join our Ambassador Club and introduce us to someone that may benefit from our services that we meet with, or if you bring someone to one of our client educational events. So please keep that in mind. And again, whether it's an introductory phone call, introductory emails work great. We love to meet your friends, family, those that you care about, to see if we can help them as well. So thank you again for tuning in to our Outlook video. Look forward to being in touch with all of you soon. You know where to find us, and have a wonderful 2024 year ahead. Take care.